Hey, has anyone seen Goku? Goku. Goku! Hello? Where are you, buddy? Goku. Whoa, how'd you do that? Instant transmission, right? I got my costume on. It's time for Halloween. I brought you a bag so we can go trick-or-treating. What do you mean we're too old for trick-or-treating? You're never too old to go get free stuff. Hey guys, welcome back to the After Hours. I'm the ATL Beast, and today we're gonna talk about limits of penny stocks. Now, one of the things you have to know is that penny stocks have a limit. Now, what do I mean by limit? That means there's a bottom limit as well as a top limit. When we talk about the bottom limit in trading, we're not just talking about profits. We're not talking just about strategy. We're talking about the entire thing in general. We're talking about theory. When we look at the theory behind trading, especially trading in penny stocks, it all comes down to probability because you're in an environment of ambiguity, which means every single day in the market, you are facing the unknown, uncertainty. Now, when we consider penny stocks, you have to understand that there is an entry and there's an exit. There is a position size and then there's your account size. When we talk about trades, there are an unlimited amount of trades that you can make, especially if you have the funds to do it and you have the means to do it, either through a broker or some other way. The only common variable between all your trades is the stuff that doesn't change. And we're talking about your position, just having a position in general, not a particular position size. Now back to the theory, we have to first define what is trading, especially in penny stocks. When we talk about penny stocks, a lot of people just think that the stocks either go in the direction of your trade or away from your trade. That means, are you winning money or are you losing money? And what you have to understand is there's more to it than that. There's the people that go in with a plan, and then there's people that go in without a plan. The difference is gambling. If you go in without a plan, you are pretty much taking the 50-50 chance that it's either gonna go up or it's gonna go down. And depending on if it goes in your direction that you chose, you'll make money. But it's a long-term game. This usually starts out as a hobby for most people. And that's where it gets into the gambling stage, to where you go in with the idea that you are trying to predict what's going to happen. But the longer you get into your trading career, it actually turns into how much money am I willing to risk? We're talking about risk management. Now, when you start a field like penny stocks or anything where there's unknown and continuous learning, you have to understand, you have to be confident with every decision that you make because that determination is going to determine whether you are successful or not. And in this case, the only thing that you can control is the money that you put inside of the stock. You can't influence the direction unless you have a lot of money. We're talking buku bucks. And even at that point, there's always someone bigger or they have more authority that can probably manipulate the stock. So a lot of beginner traders, they think that you're here to make money. And that pressure can actually cause a subconscious effect that ends up making the person lose money. There's actually a quote out there, but at the end of the day, it counts as more begets more. When you lose, you actually end up losing more. When you win, you continue to win more. When you get into trading, you have to have the courage to try, the courage to press the button. But you're not gonna do that unless you're confident. And you have to be confident in something specific. You have to be confident in your control. You can't control the market, but you can control how much it's worth to you. The second thing you can control, as well as limit, is your emotions. When you are trading, you're not supposed to have an ego. There are times where you're very excited. And depending on whether you're in a negative or positive headspace, that can amplify which direction your trade takes. Now, the trade itself, talking about the stock and ticker, you're going against computers and a few other traders. And unless you put in a lot of money and you have a specific strategy, trying to blow up a risk management of a robot, or you directly target a guy with a similar size, there's not much you can do other than just wait and risk. One of the main principles of risk management is risking a little so you can make a lot. And now that has to span over the course of the series of trades that you make. And so you have to tailor it to a specific setup or a specific idea or price action, anything that can be considered a trade signal. Now, when you do that, you can enact discipline around that setup, that specific trade signal or setup. The discipline is going to be on your emotions because around that setup, you're going to want to change things, either put more money or put less money. Sometimes you might even go early or a little bit later, and any small mistake ends up accumulating over the entire course of your trading career. There's a lot of people that are called boom and busters, where they make a lot of money in their first year and they become arrogant, and then they lose all the money and more the next 2-3 years. And those people that do small account challenges, where they go long on a lot of stocks and they actually make a decent amount of money throughout the entire year with a small account challenge. They go long on stocks, and they can do that because they risk a very small amount and they let their winners run.
Now, I usually shy away from the low quality biotech. Unless it's a high quality setup, I try not to trade it. Now, we did see a low quality long setup that ended up becoming a long liquidity trap. Now, that made for a great opportunity for a short. And we saw that looking at SPRC. Now, SPRC, this was a long trap because it had a lot of volume, over 10 million volume in the pre-market. Now, all that volume was matched with massive extension. That means it was over 100%. It went from almost $3 all the way to $9 before the market even opened. Now, having that almost 200% extension before the open, there was bound to be some type of pullback. Or if there's not a pullback, there's at least going to be a rest. Instead, when it comes to these biotechs, we understand that they can be very volatile just by their nature.
In the beginning, a lot of people believe that trading is boring. Well, in reality, boring trading is good trading, because boring trading means that you are doing your statistics, you are making your plan. Most of your work is in the preparation and analysis, but less than 20% of it is actually done trading, because you're going after the high odd opportunities like you should, and you're always making those tweaks to get the better part of your edge in the market. One of the biggest principles in here, if you haven't realized it already, is to survive. The longer you survive in the market, the more you see. You need your personal edge. You need your personal discipline. And then eventually you'll find what works for you. And once you find your niche, you dig into it. It's usually a good idea to master one setup before you move on to the next. It usually takes about 3 months. You need enough data. You need to backtest. There's a few other things you can do, like screen time. The more screen time you have with focused intention on specific things in that specific setup, you start to see a pattern. Noticing those small details is more important than someone actually giving you a trade. That usually doesn't work. One of the biggest principles you can follow in trading is having your own will, free will. If you're following anyone trading, you won't make money for long. If you don't think for yourself, you'll never actually grow. Now, you can take an idea or spot something on a message board, but it's never a good idea to jump in on a trade just because someone else is doing it. You could make that money, but all you're doing is affirming the wrong action, and that's to follow someone else. So the last thing I want to say is trading is all about habits. You make money from your habits that you learned, especially in your first year. If you create bad habits, they're going to show in your profits. If you create good habits, they're going to show steadily. And if they don't, you have to be persistent until they do positively affect your account. Everything's fair game because you create the rules, and only you can say if you're doing well or not. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.